I had a question earlier on during a coaching session this week. A customer had asked if I'm planning on selling premium, um, whether it's a call or a put. How can I use your tools, of course, to see the expectation of what that option I'm thinking about selling would be if the stock fell to the price? I'll use Annette as an example to sort of illustrate what I'm referring to. So what the customer was asking, in a sense, is that if we were going to say, do a cash secured put. So let's pull up Annette. We had the nice move today, up about 7%, not related to earnings. The earnings move happened a few days ago. This was a little bit afterwards, and I think Arista actually appeared in one or two different IBD watch lists within the past days, and that sort of buoyed the buying up on it, I should say, as well as other information that had been coming out. But let's say I was considering selling a 14-day out cash secured or naked put. Stock just had this move up, looks pretty strong. I'm thinking of maybe selling a 125 put for about 14 days out. So we get a premium of about $2. The delta is around 0.26. Maybe I could squeeze up to the 126 here for a little bit more premium. It's still a delta under 0.3, or at least about a 70% probability above. Of course, there's nothing wrong with going to the 78% probability or the 80% probability in this case, and still looking at a 1.1% yield or so. That's not the naked yield, I'm sorry, but close, a 1.2% naked yield, but right at the 125, let's say that's a 1.7. Again, this is not a recommendation or suggestion. But the customer's question was, if I was looking to sell this, but I wanted to know two things. What would happen if the stock fell to 127 in the next day or two? What would my premium be? Or if I wanted to know when this premium would be $4, what price would the stock need to be trading in the next couple of days in order for this to be actually a $4 premium, close to where the stock's at now, 131, if I was looking at the 125. Now, the easiest way to do this on PowerOptions, of course, to calculate what your option might be worth, is if I'm right here on the chain, already looking at my option, I'll want to go into the More Information button. We'll go into Calculators, and we'll go just into Black-Scholes. It's just a simple Black-Scholes calculator. Shows us, hey, the stock's currently at 131.07. We're analyzing a 125 strike put with 14 days remaining to expiration, and our current implied volatility in this option is 0.4154. No dividends, and the interest rates, of course, are now back up to 4.45. So when we scroll down here, we see our little time decay curve that we'd expect if the stock essentially remained at the same price over the next 14 days. And down below, we have a running tab of what the premium is expected based on the theoretical Black-Scholes pricing model every day between now and expiration on November 18th, 15 days away. Naturally, we're just seeing some time value decay out of this option as we move forward to expiration with the stock remaining at the same price. So in a couple of days, what is my expected value of the 125 strike I'm considering selling if the stock falls down to, let's say, 127? Simple, we just change the stock price, leave everything else alone, click use these hypothetical numbers. Yes, there might be a slight change in implied volatility if the stock drops 4 points in the next day or two. Now we see a different time decay curve. And as we scroll down, we can see that our put value here would be expected to be about 307 instead of 210. And then the next day it'd be about 293 instead of where we are right now at 210. A simple tool, and I know you've all used Black-Scholes calculators before, but this is one of the fastest ways to just analyze what would my option that I'm considering selling or buying be worth if the stock fell or rose to a certain price in the next 3 or 4 days while still having 10, 15, 20 days to expiration. Just link from the chain to the Black-Scholes, to the calculators, and then to Black-Scholes, and you've got it. Now, the other follow-up, okay, we saw here that the expected put jumped to 307. We're at 210 in real time right now at the close of business on November 4th. What would I need it to be? 420, double the 210 price. Where would I need the stock to be trading? Well, again, we saw here that that 420 price is currently right at the money for this 14-day out position. So I'm going to say if the stock was trading at 125 exactly, we might see a theoretical value in a day or two of 420. It has to be at the money in order to see that price. Let's give it a go. Change our stock price to 125. Put strike price here. Oof, we only go up to 395 on the theoretical value, but we could maybe speculate that with a 6-point drop on this stock, it's not a huge drop, right? It's only about 4%. But in the next couple of days, if it drops back down to 125, maybe the implied volatility moves up to a different level and we can change that. But here we see that, of course, we'd be starting off with a put at 395 or not quite double. So that tells us we'd probably need a stock price of 124.25 or maybe 124.50. Get a little bit of oomph there. Yep, 124.50 puts us right at 419. Almost double of where we are. But of course, if the stock was trading at 124.50, I'm not likely selling a 125 at or slightly in the money put, even though it's double the premium. I'd be looking at the 120, probably closer to the 117 or the 116 at this time to get that delta that I want for an out of the money put with the probability of expiring worthless that I want in that 80 to maybe 85 range or 75 to 85 range as well. There is a second way to do this, of course. So if I already knew that I had already sold this 125 put on Annette for 14, 15 days away, we'll use the custom spread tool, which is essentially the profit and loss chart you can put in any position, but when you're using the search in PowerOptions, or you're tracking the position in your portfolio, and from the portfolio you link to the profit and loss chart you'll be taking here. But from scratch, I can just build this Annette position as I sold it today. And we're going to put in the stock. We're going to select our option, November 18th, 125 put. And this is not an actual trade. We're just using this as an example. We're going to say we got the midpoint at 210. So if I put in a covered call position, oops. Sorry about that, folks. If I put in a covered call position, we put in that we bought the stock and sold the call. If it was a spread position, we would have added both the option legs in naturally. And here we go. So we've got about a 1.7% yield as long as the stock remains above 125 in 14 days, and our put expires worthless. And we see here just the standard profit and loss chart, our break even natural 122.90, simply the option premium received 210 minus the 125 put strike price. So the stock was trading at 122.90. To close the position, if I didn't want to take assignment, intrinsic value at expiration would be 210. So I'm at a wash. I took in 210, paid out 210. That's our break even naturally. Down below, there's the calculate field. And what you can do here is the same thing we saw in the Black-Scholes pricing model, but it's just giving you the expected gain or loss on your particular position if the stock is trading at an expected price on any expected day between now and the expiration. So what happens if the stock goes up to 135 in the next 3 to 4 days? How much time decay can I expect if by the 8th the stock moves up just 4 points? Okay, well, not too much. I mean, it drops down to 77 or getting closer to expiration 14 days away. So the theoretical value is showing us to be around 77 or so to buy back. So we'd make a profit of 133 out of the max expected of 210. In theory, not etched in stone. If the volatility drops as the stock moves up, the price will naturally be a little bit lower. If implied volatility moves up, the price might be a little bit higher. But we wouldn't expect to see the implied volatility move up as the stock moves up. It'd be easing off some of the fear there as well. And again, of course, that's a 4-point movement. So 4-point movement's the other way, just as we saw before. What happens if it drops to 127 in the next couple days on or around November 8th? Okay, we'd expect an increase to go up to about 282 or a loss of 72 cents if we had to buy it back. Why would I target 127? Well, that's close to what we call the 1% rule. Meaning if the stock falls to within 1% of the short put strike price or the sold put and the bull put credit spread position, we might want to consider taking action to roll or adjust the position before it goes in the money, maybe risking being assigned early or having a larger buyback cost where you have to roll out further. Now, this is still a pretty big or pretty much higher buyback cost, 1/3 actually of the initial price we received. We got to pay $2.82 to buy it back, so we're putting in 72 cents, 1/3 of the premium we initially received, roughly. But again, it's to prevent that to going up to $4, $5, or $6, having to pay that to close it, then having to roll out to February or maybe March to try to roll that $6 for a credit, including the $2.10 we received in that case. So that's just another way that you can do it to evaluate what is your expected monetary profit and loss on the position. And of course, the graph here redrew in the sense that the red line here was originally drawn at the halfway point when I entered the profit and loss chart, halfway between now and the expiration. So it would have been around the close, the 11th or so. Yeah, the 11th. But when we changed it down below, it redrew the red line of the expected profit and loss chart here based on our selected date of 11/8, 4 days into the trade in that case. Yes, 4 days into the trade. So those are the two ways you could do it again. Find the chain, your option that you want, go to calculators, go to Black-Scholes, see what the option price would theoretically be worth for movement in the stock price or changes in volatility, implied volatility of the option if you're expecting that. Or you can build it in the profit and loss chart / custom spread tool. You have your basic graph here, profit and loss chart, and then down below, you can use the calculate feature to help you determine where your option or where your position's value might be total if the stock fell a few points in the next few days or rose a few points in the next few days as well, helping you analyze what your buyback cost might be, what alert or trigger you might want to set in the portfolio tools as well. So that was a discussion we had earlier this week with one of our coaching sessions. I just wanted to bring that up to remind everyone, of course, the couple of ways you can use the tools in PowerOptions to help you analyze the theoretical price of the option if there's a change in the price, change in the value. And yes, of course, someone said, does this work the same way with spreads? Yes. So let's say this position that I just entered is not a naked put. I actually did a bull put credit spread on Annette, where I sold the put, of course, which obligates me to buy shares of stock at 125 of the stocks trading below it. But in case the market goes wonky, we're going to buy a lower strike put here. Let's just use the 120, a standard 5-point spread. So we're going to buy the lower strike put, and this is going to give me a strain. Oh, it's okay, 115 at midpoint. So I still take in the 210. But now I've got to pay 115 to buy the second put at the lower strike. So that gives us a net credit of 95 cents. However, I don't have the full obligation, or even if I'm using margin, the margin obligation of selling the put at 125 without it being covered. The 120 put covers that. So for one contract, we'd only have a true loss if realized. If the maximum loss was realized, it would only be $405 per contract. Now, I may have to put up $500 full with my broker to cover the obligation between selling the 125 put and buying the 120 put, of course, because that's the most I could lose. What happens if the stock's below 120? Well, if I do nothing and hold it to expiration, the stock's at 118, I'm going to get assigned shares of stock at 125 to cover the obligation of the sold put. I have the right to sell those shares of stock at 120, rather force someone to buy them from me at 120. A broker would do that for me. Essentially, I'd be assigned on the short, and then they'd exercise the long to cover that obligation. Just have to cover the difference in strike prices. So yes, I'm down 5 points on the position. But we keep that 95 cents regardless of what happens. That's deposited in your account right away. So the max loss is 405 in those scenarios. But to the point, just the same way we did before, I think this was Kevin that asked this. If I've got a spread position here, my original premiums taken in, same situation. The stock falls down to 127 in the next 2 to 3 days to November 8th. It would cost us $282. We lose 72 cents on the short put if we were looking to liquidate the whole spread at that time. And we've only gained, theoretically, $27 on the long put. We could sell to close it at 142, the expected value in those cases. So this would be a loss of only 45 cents or $45 per contract, 1/9 roughly of the true maximum loss on the trade. So that's still pretty good, but it's still a loss. But yes, Kevin, this allows you to analyze if you're in a covered call, an iron condor, a four-legged spread, a double diagonal, a different four-legged spread, or just simple vertical spread, credit or debit, or diagonal spread with two legs. You can see the value of both of those using the same calculate feature to see what the total expected profit and loss would be on the multi-leg positions, just as we did with the naked put a moment ago.